On Friday, February 16th at about 1 p.m., a 37-page indictment alleging a criminal conspiracy by Russian agents to meddle in the 2016 U.S. presidential election was posted on the website of the U.S. Justice Department. What's lost in the headlines is that faith in the nation, as measured by the stock market, remained unshaken. Stock prices barely budged, displaying what makes America great. Investors faced a week of terrible news. The tragic shooting at a high school in Parkland, Florida, overshadowed a drop of 11.8% in stock prices just a week earlier. Then came the indictment revealing the Russian plot to undermine confidence in our government. Share prices of America's largest companies stayed stable because investors wisely focused on the long-term strength of U.S. economic fundamentals. Here's some insight into current economic conditions and the kind of ongoing analysis required to manage wealth prudently for the long term through good and bad times. The economy is measured quarterly in terms of gross domestic product, GDP, which is the sum of four factors: consumption, investment, government, and net exports. Net exports were a drag on GDP growth in the final quarter of 2017, but net exports are volatile month to month. Its dips over the past two cycles of expansion and recession since January 2002 have been followed repeatedly by surges. Government spending, which includes state and municipal expenditures, has been rebounding after suffering years of cutbacks in the Great Recession and its aftermath. With real incomes rising since the financial crisis, tax receipts have risen and state and local government spending has increased, which has been a positive factor in GDP growth in recent years. Gross domestic investment has been stable for years. Consumer spending is by far the most important of the four factors calculated, accounting for 69% of U.S. economic activity. Government spending, net exports, and business investment combined are not even half as important a factor in growth of the U.S. economy as consumers. If consumers keep spending, the good times for the U.S. could keep on rolling, and there is some reason for optimism on that score. Consumer strength rose in closing out the year, extending the strong growth trend experienced in recent years. In addition, in February, a lower rate of withholding federal taxes on employee paychecks kicked in, putting more money in consumers' pockets to spend, which could show up in GDP growth figures to be released in early April 2018. Economic growth shows up in profits of companies, which is the key determinant in the price of stocks. Profit expectations for the Standard & Poor's 500 companies grew sharply in recent weeks. When the tax law was signed on December 22, 2017, the average company in the S&P 500 was expected to earn $131 a share in 2018, but that was revised to $152 and could be boosted again. The 11.8% correction of early February was followed by the best week for stocks in 5 years. Stocks gained 4.4% for the week, and the news on Friday afternoon of the Russian plot was inconsequential to investors. Volatility has risen, and the chance of a bear market decline of 20% or more looms larger as the 8.5-year bull run grows older. The new tax law increases the chance the Federal Reserve will make an interest rate policy mistake by quashing growth or allowing inflation to surge. And Fed mistakes caused every recession in post-World War II history. However, earnings drive stocks, and earnings expectations have been surging, bolstered by the new tax law. With real wages continuing to grow, consumers are spending, and consumers are the biggest driver of economic growth. So, the bull market and economic expansion could continue for months and head much higher. The good news is that the stock market's performance on Friday indicated unflinching confidence of investors that justice ultimately will be done. America is fixing the problem for all the world to see, and investors remained confident.